Okay, in this applied series video, we're going to touch a little bit on something out of level 2, but it's really present in level 3 derivatives, which is volatility skew and the term structure of volatility. And I'll be using the SPY, the ETF that tracks the S&P 500, to demonstrate this. And I'll show you the opposite of what the S&P 500 is doing using an ETF called VXX, which is an ETF that tries to replicate the VIX index using the front 2-month contracts. So before I start showing you all the charts of what skew looks like now versus what it did a month ago, and that's why I think it's interesting right now, is because of what's going on over the last month. Even though the market has sort of melted up over the last month, the skew has become more pronounced, which means that put spreads have become much cheaper. Now, some of you may be thinking, hang on a second, if there's skew, volatility skew, wouldn't put spreads become more expensive? They become cheaper. So I will show you. It sounds counterintuitive, but I will show you how that's done. Let's just, what I have on the screen here looks like a normal distribution, right? But it's just an exaggerated sort of a visual of what puts and calls would cost. Here's on the vertical axis, we have the price of the option. And on the horizontal, we have different strike prices. And here we are at the money. And if we had constant implied volatility, in other words, no skew, and that volatility would be equal across all strike prices, an at-the-money put and an at-the-money call would cost the same amount of money, would have the same value. If we move a certain direction, a certain amount of points away from the at-the-money strikes for calls and for puts, we should find that they have pretty much the same price as well, that we should have a symmetric distribution of pricing. What changes the shape is the supply and demand imbalances in the market, the demand for puts and the demand for calls. And it's typical that there is negative skew on the S&P 500, and I'll just refer to it as the SPYs. There's typically negative skew, only because when markets go down, they go down very fast. They move there very quickly, but when markets go up, they move there very slowly. So there tends to be more put buying than there is call buying. Typically, if you want to hedge out a position, you can do that by call selling. So you can sell covered calls on a diversified portfolio of stock by using the S&P 500 to reduce your beta exposure. So what happens is the price of the puts tend to get pushed up, and the price of the calls tend to get pushed down, so that you end up with something that looks more like this. This is exaggerated now, mind you, but it's just to make the point. You end up with something that looks like this, and that gives you skew, where you have elevated prices or premiums on puts and depressed prices or premiums on calls. And because everything is constant, the only thing that can change is the implied volatility. So we measure the skew by the implied volatility across the strike prices. So we'll find where we are at the money, and we'll look at the implied volatility for calls and the implied volatility for puts, and we can chart that, and that will give us skew. And we'll look at that in a second. We'll look at it for 5 months, and we'll look at it today versus a month ago. If we look at the term structure of volatility, which means we're going to look not just at, let's say, October expirations and then just look at a whole bunch of strike prices for October, but if we look at October, November, December, January, February, March, and we took a particular strike price and we just plotted the implied volatility over time, you would get an upward sloping curve called contango, and that's quite normal as well. When fear starts to rise, the short end of this curve starts to increase and the term structure begins to flatten out. And when fear is really high, or typically when the market is selling off, you can get an inverted term structure of volatility. So the question is, what do these things look like now? And what did they look like a month ago? That's the interesting thing. So let's start with the term structure of volatility now on the S&P as of, what was today? Today was September the 13th. And we'll look at what it was a month ago. Then we'll look at some skew. Okay, so along the vertical here, we have the level of implied volatility. And across the bottom over here, we have time to the option expiration. And the lighter dots over here with the line connecting it, it's an interpolated line, is a month ago. And this is where we are today in the darker yellow line. So you can see that across all dates, implied volatility has increased over the last month. And over the last month, the S&P index has been squeaking out new highs every now and then, but not spectacularly. But we have been grinding higher, and again, not spectacularly. We haven't had any major big breakouts where we run 50, 100, 150 points over the course of 4 or 5 days, but we've been inching our way higher, but so is volatility. And you can see how this curve, is really pronounced in contango here, but we're beginning to flatten out. You can see a lot more activity at the front end of the curve, a lot more volatility in the volatility, and that is a thing, the volatility of the volatility. So we have heightened fear. Whenever volatility increases, it's called the fear gauge or the fear index for a reason, because you're getting to get higher implied volatilities in here, you have a supply and demand imbalance for protection. So this is what the term structure looks like. Let's see what they look like at particular expirations. And we should see that as we go further out in time, we should see that we have increased levels of volatility. Okay, here is our skew for 4 months. We'll look at this first, then I'll overlay all 4 onto one chart. And what we're looking at here is today. The darker lines are as of today, and the lighter lines are as of 1 month ago. And we can see for all months here, you can see up here where I've got the check mark. This here is October over here. We have in the bottom chart down here, we have November, we have December up here, and we have January of 2022. So October, November, I'll just write here, October. Well, let's see if I can get a pen that works here. October, November, this is December, and this is January. And you can see 446. You can see it just lightly over here. This is where we were today when I took these screenshots, 446. You can see where volatility bottoms out in terms of where the calls are. It has a low level before the volatility on the calls begins to rise, and kind of like a small little smirk. This wouldn't be considered a smile, it would still be, a smirk. But you can see the skew on every single one of these, and you can see that every single one has higher volatility at all strike prices consistently, with October having the largest increase in implied volatility versus a month ago, but they're all up versus a month ago, October being the highest one. Let's overlay all 4 onto one to see if we can spot the term structure for the at-the-money calls. We should see that the October curves are below the November curves, which are below the December, which are below the January for being at the money. All right, so we're going to go down here at the money, and then if we just draw our line up, we should hit October, which is the orange line first, which we do. Then we should hit the red line, which is November, which we do. The green line should be above that, which it is, and the blue line should be above that, which it is, which gives us that upward sloping term structure. As we move more out of the money, it does change. We have much higher implied. So if we go down to the 400 strike, notice that it's reversed, that your near-term options are going to have much higher volatility, and as we go further out, volatility tends to drop. So this over here This is consistent, by the way, because it's an upward sloping term structure of volatility. The curves themselves are consistent with what typically happens on the SPY, which is more demand for puts than there are for calls. This is sort of interesting over here, is that you're going to have much higher near-term volatility. So we can do some things with this, and I'll show you a couple of interesting trades that we can work with on this one. This is September, by the way. You can see the sharpness of September, but September's got one more week to go. So usually when you get that close to expiration, there's not a lot of information in these options. This is typically why you'd want to go at least 30 days out, if not more, to get some good information. So let's go back to the original screen that I had, and we'll look at a risk reversal, and we'll look at some spreads. Okay, so I'm going to show you two spreads, a December spread and an October spread. And if you are sort of nervous about where the market is, the October put spread is cheap. To get 30 points out of the October put spread, it's very cheap. You may think, well, if there's a higher demand for puts, wouldn't the put spread be far more expensive? It's actually much cheaper than the call spread. The call spread is really expensive. So we'll look at 30 points up, 30 points down on call spreads and put spreads, and we'll look at a risk reversal. The risk reversal is really interesting for for December, because it's extremely asymmetric. So just to sort of get your mind in the right place of the pricing that you'll see and why the pricing is the way it is, let's just move a certain amount from at the money upwards, and we'll move the same amount downwards. And keep in mind, this is just a really exaggerated chart. It's really stylized, but it'll still make the point that I want to make. And we'll just move this up to the curve, wherever we happen to be. And remember, this is the price of the options. So if we draw a line from an at the money to whatever that price is, and we'll take this put over here, and we'll take this call over here. And if we were buying a call spread where we bought an at the money call, so that is C1, we'll call it, and we're going to buy this call, and this is C2, and we're going to sell this call, and that'll give us a bull spread or a call spread. This right here is the price that you'll pay. This here is the price of this one. There's the price of that one. But if you went the same number of points towards, in the money, if you were thinking about puts, and you bought this put over here, let's call that P1, we're going to buy this one, and we're going to sell this one over here, P2. Look at the difference. Put spreads are super cheap when you have very elevated skew on the S&P 500. So you look at that, you say, wow, it might even be worth it just for speculation to buy a put spread. How much can I make, and how much do I have to risk on the put spreads? Now, if you don't have any directional bias on the market, you would look at a put spread with elevated volatility and say, look, it's a speculative play, but it's a low-cost play for the payoff that I'll get. Sure, even a risk reversal is interesting. But if you think, or if you are nervous about the market at all, suddenly the put spread becomes a very low-cost way to engineer a nice payoff. So let's look at the put spread on the on this ETF, the SPY, for December. We'll do December, and we'll do October. We'll do a near-term one for October, and we'll take. I did it the charts today and the pricing today at 446. I think the market ended 447, but the prices would still be the same if you're going 30 points up and 30 points down. So we'll go from 446 up to 476. That'll be our call spread. And 446 down to 416, that'll be our put spread. Both these spreads are 30 points. They're both 30-point put spreads. The call spread will cost you $12.40. So on one option, on one call spread, you'll pay $1,240 for a potential $3,000 payoff, which isn't bad. The put spread will cost you $756. Look at the difference in price, $756. And in fact, if you really are very bearish and you think that, no, I don't think we have any significant upside at all, you would sell the call spread and buy the put spread, and it will give you money right away, so that your break even will be somewhere above 446. It'll give you money right away. Let's look at October. October becomes a little bit more interesting. We'll do the same thing. We'll go 446. We'll go 30 points up to 476, and we'll go 30 points down to 416. Now, I could have gone wider. And if you go wider, obviously it'll cost you more to put on the spread, but your payoff will be higher as well. Here, this will cost you $756 to put on the put spread, or $756, and it pays off, if you're right, it pays off $3,000. But this is December. The market would have to stay down until December, or you would have to know how to step out of a spread. You wouldn't close the whole spread, but you'd step out of the spread and turn it into a reversal. I'll show you that at the very end, but let's say that you have some near-term concern, especially after looking at the level of volatility, and you're saying, okay, well, what can I read into that? There are two things you can read into it. Number one, the market is right. There is a certain level of fear, and if people are buying this insurance, if investors are buying this insurance, and it has been elevated over the last month, and people have insurance in place, maybe they are more willing to engage in selling, which would then cause their options to pay off very well. If they're protected, maybe they're not that concerned. Maybe they're not that cautious. Or you could say, you know what, the market's got it all wrong. Where are you going to go? Where are you going to go? To bonds? What catalyst is going to force us to sell off 10%? Because to go from 446 down to 416, 30 points, what is that, 7%, 7.5% on the way down? What catalyst is going to get us there? And it's going to have to be a sustained catalyst, because you're not going to get 7.5% in one sell-off. You're going to get it over a period of a week. Well, what's going to get you there? We're a month away from earnings. Still, usually mid-October is when earnings start coming out for the third quarter. There's no real significant catalyst on the horizon at this point, unless we think that the Delta variant is going to really start to peak soon. In other words, every day the cases are going to start to climb. More and more is going to happen, and maybe some shutdowns are going to happen because of this, or maybe some constraints in the supply channels. Again, you would need some catalyst. Very rarely is, well, you know what, valuations are stretched. Very rarely is that going to be the catalyst for a significant sell-off. There's going to be something that causes some concern. Now, there is this potential bond default that's happening with the in China. I forget the particulars of it, but that is going on. That I'm hearing is a big deal, but I haven't quite given it a lot of thought. But anyways, let's look at what October has. All right, if you want the call spread, it's going to cost you $698 to go from 446. 693, not 698, 693. Only because this is only 5 cents. $6.98 is what the call is going to cost you at 446, and 476 is only a nickel. Like, there's no one is even thinking that the market is going to be above 476 or 30 points higher by the end of October. No one. The put spread is 554. The put here is 825. Look at the difference in price. 446 put is 825. 446 call is 693. And this is very close to at the money, and you can see that the put is extremely elevated. $5.54 or $554 for a $3,000 payoff. And again, if you think that that's where we're headed, you can sell the October call spread to pay for the put spread. In fact, I wouldn't even sell the call spread. You could just sell the 446 call and get 698. What's the point of the nickel? It'll cost you more in transaction fees to get that nickel. 554 for a $30 payoff, which is rather interesting as well. So this is if you're buying. You want to buy the put spread on either one. If you are buying the put spread, I think October is probably where you want to go, because if there's going to be an issue, it'll probably be more near term than long term. Let's look at a risk reversal. I think this is the more interesting trade right now, because if there is going to be a correction, it's not a sell-off that we're going to get where we're going to find a new lower level on the S&P, and that's where we're going to be. If there is going to be a sell-off because there really is no other place to be, it might be for a couple of weeks, if there is one, and then up we go again. We'll recover and money will come back into the market because, again, there is no other place to be. So I like risk reversals a lot better. So let's look at the 446 risk reversal for December. And I did a video a while back where I said, I can see an end-of-year price target of 4,600 on the S&P, which would translate to 460 on the SPYs. So if you buy the 460 call, that's 14 points up, or 140 points on the S&P 500 index. Well, how are you going to finance that? Because when I do risk reversals, I want zero cost, or at least I want to be paid. This I find very interesting. I can go all the way down to 403. I can sell the put at 403, which completely pays for the call at 460. This is negative 43 points, 10% down. I can pretty much bet that if we are going to get a sell-off, it'll be a correction. Certainly not a bear market sell-off of 20%. If we even get to 10% correction before other players come in and say, you know what, 7% down is good enough for me, I'll take it. This is 10% down. This is a zero-cost risk reversal for December. I have 403 financing a 460 call. And if the the news is good over the next month or so, if we see the Delta variant peaking in the next week or two and then starting to subside, if we see more people getting vaccinated, if we see more supply coming on the market, some supply bottlenecks loosening up, more supply hitting the market, more things opening up, earnings that come in better than expected again, you could surpass 460. So it is again, the risk reversal is a nice speculative play on beating 460. And not only that, if we do get a correction of 10% down to 403, I'd probably want a long position on the market at 403 anyways. So on the downside, I'd be buying the market 10% lower, which is probably what I would do anyways. And I do have a call option on the upside. There's my little lottery ticket for Christmas to see if it pays off. If it doesn't, well, nothing ventured, nothing gained, right? I didn't pay anything, so I'm certainly not going to make anything. Now, I don't have to be this aggressive. I don't have to go to 403. I can go to 420, let's say, or I could figure, well, if we do sell off, let's say 7.5%, I could figure out where 7.5% is, sell that, put over here, and actually turn it into, a source of income if it did that. If I did this one, let's say the 446 to the 416. Let's say I did a put spread, which means I am long at 446 and I am short at 416. And we did have a sell-off that was very immediate, and by the first week of October, we're thinking that, well, that's about as far as we're going to get. Looks like we're about to reverse and turn around. The selling is a little overdone. We've maybe hit 7 or 8%, and we're seeing that the market's well bid and we're not going to go any deeper. I would simply close the 446 and hold the 416 short put. I would step out of the put spread, take my profit on the 416, and if we did sell off at that point, I would then use the profit on the 416 to buy a call, probably buy the 446 call if we're anywhere near the 416 on this one. And for the risk reversal, if we were pushing down to 403, I'd probably put one on. I'd probably put, I shouldn't say one, but I'd probably put risk reversals on about every 10 or 15 points down, which means being that we have this asymmetrical payoff, if we did have a major sell-off, what would happen with the curve here is it would start to do this. It would do this even more, which means that this would become even more asymmetrical. So from 446, let's say down to 431. At 431, I'd probably say, okay, well, let's take the 445 call. And how deep can I go in the puts to finance the 445 calls? And I would ladder my way down that way so that when it did reverse, the last ones I put on would start to pay off first. So that if this guy that I put on first never pays off, oh well. Never pays off. I didn't pay anything for it to begin with. So I don't know exactly what I'm going to do because I can't read the market right now. I could go either way. I could say, yeah, I think we're due for a sell-off, and let's start stepping into some risk reversals. I'm certainly not going to take a full position if I do this. You know, I might take 10% or 15% of what I think a full position would be. Now, if I think the market's got it all wrong, and that, you know what, this heightened volatility, yeah, okay, so there's a lot of worry in the market right now, but where are you going to go? If you really think it through, if I give you a weekend to think it through, you'll probably come to the conclusion that, you know what, where am I going to go? Where am I going to go? I may as well just stay right where I am. So all of that volatility will just subside. And if earnings come in the way that they came in for the second quarter and the first quarter, you know, where the majority are beating revenues and beating earnings, you don't have your catalyst. In which case, I probably wouldn't want to do a risk reversal that gave me nothing. I'd probably want to tighten up my risk reversal. So at this point, you know, I'm on the fence as to what I want to do, but I have some options of what I want to do. I'm certainly not buying call spreads. They're too expensive. I don't like selling calls on the market because the market has, over the long term, an upward bias. I much prefer selling puts on the market. The question is, am I going to construct a $0 risk reversal or something more significant? What I would like more than anything in the world is the market just to make up my mind for me. I would love nothing more than to wake up tomorrow and find the market futures down 30, 40 points. There we go. You've made up my mind for me. Now, if you don't like playing the puts, if you don't like doing this, let me just erase something here so we can have a little bit more room. And I will draw this out again for you. All right, let's put our strike prices here, and let's get a symmetrical price distribution for calls and puts. And this is the VXX now. We did the SPY. VXX will have a skew that is opposite the SPY. This is meant to track the volatility index, the VIX, and typically when markets sell off, volatility rises. So you get the opposite effect on the VXX that you do on the SPY. So you'll end up with elevated call prices, a skew on call prices that tend to look like this, and your put prices will look like this. So that your call spreads on the VXX are much cheaper than your put spreads would be on the VXX. So if you prefer to do something on VXX as opposed to SPY, maybe you don't like the margin requirements on SPY, maybe a call spread is too expensive for you, you'd like something smaller and more manageable. The at the money price on VXX right now is $26. So let's do, we'll do a spread, a bull spread on, or a call spread on VXX and a put spread just to see the difference between the two. Back in July, last week in July, or second last week around the 20th of July, there was some volatility in the market, and it had sold off, and the VXX breached $35, and we're at 26 right now. So if you think we're going to get something comparable to what we had in July, and July wasn't big, by the way, it was at 5-6%. That was about it, 4-5-6%, I forget. But then it recovered as quickly as it came. It went, and off we went. So if you think, well, you know, we're at 26 now, 35 might be in the cards. Let's say you want to go to 32. You'll pay about $280 for a $26 call. And this is for October, by the way. We're October, expiration third Friday in October, October 15th. And if you go to the 32s, you're getting about 166 for this one here. So you're buying the 280 and you're selling the 166, which is $1.14, or $114. That potentially has a $600 payoff if volatility spikes to over 32. And again, the last week in July saw it, the VXX, I should say, not just volatility, but the VXX spiked over 35 for a few days and then came right back down. As quickly as it inflated, it deflated. If we look at the same thing on the puts, the $26 put is about $270. It's cheaper than the call, $270. And if we go $6 down to the 20, it's almost nothing. It's like 5 cents, 0.5. So you're looking at $265. $265 for a $6 spread on the puts versus $1.14 for a $6 spread on the calls. $1.14 to pay off $600. So a $114 bet that could potentially pay $600. Seems like a decent enough trade-off, to risk 114 for a 600 payoff. Whereas here, 265 you're risking for a $600 payoff, and being that the $6 downwards, going from 26 down to 20 on VXX, the 20 strike for October has almost no premium. You can basically, they're giving them away at 5 cents each. That's expecting that the market's going to explode upwards, and that volatility is just going to drop right out of the market. Now, you may think that. You may say, you know what, I'm just going to buy a whole bunch of $20 puts on the VXX anyways. Let me spend $200 just on speculation. Hey, you never know. If it drops to 18, ching, right? But if you don't like the SPY, if you don't like the put spread, you're nervous about the market, you want to protect yourself from downside price movements, it's the same as protecting or buying upside exposure on VXX. It's kind of a nice little payoff. It's a nice way that if you're not too versed in playing volatility, it's a nice inexpensive way to play volatility, that if you're wrong, you can always back out of this early. Maybe you can back out for $50 and you've only risked $65. That's cheap tuition for your education, by the way. But if you're right, if you believe the market is right, if you think, yes, how can we be at these levels with so much going on right now? We're going into the fall. We have another wave coming of the virus. There's going to be issues. Maybe earnings aren't going to meet expectations. Whatever you think is going to happen, then fine. Keep in mind, this is October 15th. This is not enough time to really see any of third quarter earnings. So your catalyst is going to have to be something else. It's going to have to be fatigue. You're going to have to say, well, you know what? There's a certain level of fatigue, and that's it. So I'm going to bet on fatigue. I'm going to say that, we're at these really high valuation levels, and maybe there'll be some concern about earnings before we get to earnings, so your catalyst is the concern about earnings. I would say that if your catalyst is earnings, you're going to want to go to at least November, but that's a big thing to play with, because earnings, as we know, can be engineered, right? As Warren Buffett said, if you can't do it with operations, do it with accounting. So I would never bet against the ingenuity of the CFO to make earnings. So there we go. I don't know what I'm going to do at this point. I am looking at it. I'm more likely to do risk reversals than anything else, because worst case scenario, I end up being long the market, which is a best case scenario for me. I'll be long the market at 10% down, which is where I would go long the market anyways. Okay, that's it.